picture an estate worth $1,525,000. On paper, that's a life-changing inheritance. Now picture the family opening it up and realizing they can't actually spend most of it. That's not a hypothetical. It's a real math problem I'm going to walk you through dollar for dollar before this video is over. And once you see it, you'll understand exactly why Canada doesn't have an inheritance tax. It's one of the most misleading sentences in personal finance. Stick around for that number. It affects almost every family with a cottage, an RRSP, or a house that's gone up in value. You've probably heard it before. Canada doesn't have an inheritance tax. Technically, that's true. If your parents leave you $250,000, you don't report it as income. You don't pay tax simply because you received money. But here's the part nobody finishes for you. That doesn't mean the money escaped taxation. It just means somebody already paid the bill before it got to you. That somebody is the estate, sometimes for a shocking amount. A cottage that exploded in value, a large RRSP or RRIF, investment accounts, rental properties, even a family home. Every one of these can trigger a tax bill the moment someone dies, long before you ever see a check. Here's the one concept that unlocks almost everything else in this video: deemed disposition. The moment someone dies, the CRA generally treats them as if they sold almost everything they owned at fair market value 1 second before death. Nobody actually sells anything. No moving truck, no for sale sign on the cottage, but for tax purposes, that imaginary sale counts as real. Think of it like a delayed penalty. Everything looks normal until the whistle blows, and by then, the play that caused it already happened. The sale is already on the books, whether anyone agreed or not. An imaginary sale creates a very real tax bill. So while Canada may never send you the beneficiary an inheritance tax bill, death can actually create one for the estate. And that bill usually gets paid before you get your share. All right, your mother dies with $400,000 in her RRIF. You're the named beneficiary. You'd assume that since your name is on the account, $400,000 lands in your account tax-free. You may well receive the money directly. Tax-free is a different question. Unless a qualifying transfer applies, the entire fair market value of the RRIF, not just the growth, generally gets added to your mother's income on her final tax bill. All $400,000 stacked on top of everything else she earned that year, taxed at a high marginal tax rate. There are exceptions. A rollover to a surviving spouse can defer the tax. Certainly, financial dependent children or grandchildren have special rules too. But if that RRIF is going to an independent adult child, don't assume it arrives tax-free just because your name was on the form. Now here's where it gets messy for families with more than one kid. Child number 1 is named beneficiary on the $400,000 RRIF. Child number 2 is supposed to inherit the rest of the estate through the will. Child number 1 gets the money directly, but the tax bill that RRIF generated becomes a debt of the estate, which can eat into what's left for the child number 2. It's like calling a line change and forgetting to tell the player already on the ice. Nobody ends up out of position and somebody pays for it. Mom wanted an even split. Instead, one kid gets a full check and the other gets a much smaller amount because nobody coordinated the beneficiary form with the will. Naming a beneficiary is not the same thing as having an estate plan. Hang on to that thought. We're coming back to it. Now, the asset that causes the most heartbreak, the family cottage. Your parents bought it decades ago for $150,000. Today it's worth $700,000. Nobody in the family wants to sell it, ever. Doesn't matter. The CRA doesn't care about your family's plans for next Canada Day. Because of deemed disposition, your parent is treated as though they sold that cottage for $700,000 the moment they died. That's a potential capital gain of $550,000 before adjustments for renovations and selling costs. The taxable portion of that gain gets added to the income on the final return. A spousal rollover or a principal residence designated might soften it, but we're not selling it. Does not make it the tax bill disappear. Here's the part that actually blindsides families. The estate might not have the cash to pay it. You can inherit a cottage worth $700,000 and still be scrambling, dipping into other estate assets, paying it personally, borrowing against the property, or worst case, selling the cottage anyway just to cover the tax on the cottage you were trying to keep. The same logic applies to rental properties, investment properties, and shares in a private corporation. The house you grew up is usually gets better treatment. If it qualifies as the principal residence for the year the deceased owned it, the principal residence exemption can wipe out all or part of the capital gain up to the date of death. But principal residence isn't a magic phrase that makes the paperwork optional. The estate still needs proper evaluation and reporting. There's a second trap here too. Say the home was worth $800,000 the day your parents die. The estate holds on to it for a year, then sells it for $800,000. Even with the exemption coverage, the gain up to the date of death, that's $7,500,000 dump after death, can be taxable to the estate. The longer a house sits in the estate, the more the date of death valuation matters. Same story with a non-registered investment account. Say it's worth $300,000. Originally bought for $150,000. That's an unrealized gain of $180,000. A deemed disposition applies here too. That gain can slow up on the final return. Here's the part most people miss, and it actually works in your favor. When you inherit those investments, your new cost base is generally the value at the date of death, not what your parent originally paid. So if you inherit them at $300,000 and later sell for $300,000 and $30,000, you're generally only taxed on the $40,000 increase, not the whole $220,000 gain since your parents bought it, which is exactly why record keeping matters. Lose track of the date of death value, and you could end up paying tax twice on growth that already got taxed once. All right, deep breath. Not everything in this video is bad news. The value inside a TFSA on the date of death can generally be received tax-free. If a surviving spouse is named successor holder, the TFSA can generally keep a tax-free status going forward. A regular beneficiary is treated differently. So those two words, successor holder and beneficiary, are not interchangeable. Get that wrong in the paperwork and it matters. Life insurance paid to a named beneficiary is also generally tax-free. But watch this detail. If the estate itself is named as the beneficiary instead of a person, that insurance money flows into the estate. It's not automatically taxable. But now it's exposed to estate expenses, creditors, and probate. Money that could have reached your family in weeks might now take months. Remember that number from the very beginning? Let's finally open it up. A widowed parent dies owning a principal residence worth $650,000, a RRIF worth $400,000, and a non-registered account worth $300,000 with a cost base of $120,000, a TFSA worth $75,000, and a life insurance policy paying out $100,000. Added up, $1,550,000. Looks incredible on paper. Now watch what actually happens. The principal residence gain is likely sheltered if it's properly reported. The $75,000 TFSA generally passes tax-free. The $100,000 life insurance payout is generally tax-free too. But the $400,000 RRIF gets added to income on the final return. And that $180,000 gain inside the non-registered account, that taxable portion of that gets added as well. Then layer on accounting fees, legal fees, and provincial probate or estate administration charges. This family is not inheriting $1,550,000. They're inheriting a mix of assets, tax bills, and paperwork. And if the beneficiary designations weren't coordinated with the will, the people who get stuck paying the tax might not be the same people who receive the assets that caused it. That's the real inheritance tax surprise. Not a line on your tax return, a hole in the estate that shows up right when everyone's grieving and last prepared to deal with it. One more thing. If you've ever named an executor, listen closely, because this part can cost you out of your own pocket. Don't distribute every dollar the moment beneficiaries start asking for their money. The final tax return has to be filed first. Sometimes additional estate returns too. Any CRA balance needs to be identified. Smart executors get a CRA clearance certificate before handing out what's left. That certificate confirms that taxes are all paid or secured. Skip that step, distribute everything, and then a CRA bill shows up later. The executor can be personally liable for it, up to the value of what was already handed out. Being executor isn't an honorary title. Treat it like the job it is. So how do you actually get ahead of all this? Here are 5 moves. 1. Build an asset map. Every account, every property, every policy. Owner, value, cost base, beneficiary, likely tax treatment, all of it on one page. 2. Cross-check every beneficiary designation with the will. RRSPs, RRIFs, TFSAs, pensions, insurance. The will does not automatically override these forms. They will have to work together. 3. Run the numbers now. Ask an accountant or planner what the tax bill would look like if death happened today. Pay special attention to big registered accounts, cottages, rental properties, and anything with an large unrealized gain. 4. Figure out where the cash comes from. If there's going to be a big tax bill, decide in advance whether it gets covered by cash, reserves, insurance, investments, a loan, or selling an asset. Don't leave that decision for the worst week of your family's life. 5. Keep the paperwork. Purchase records, renovation receipts, cost-based history, appraisals, beneficiary forms. Years from now, that folder could save your estate tens of thousands of dollars. So is your inheritance taxable in Canada? Most of what you receive personally, no. But that's not the same as saying nobody pays tax when someone dies. RSPs and RRIFs can create a massive income hit. Cottages and investments can trigger deemed gains most families never see coming. Growth after death can get taxed again. And uncoordinated planning can leave the wrong person holding the bill. Estate planning isn't just about deciding who gets what. It's about making sure the people you love get what you actually intend when you intended it, without a 6-figure surprise showing up at the worst possible time. If your family has a cottage, a big RSP or RRIF, or more than one beneficiary in the mix, send them this video. It might start an uncomfortable conversation, but that conversation is a lot easier to have now than when someone's gone. When money moves, you need a game plan. That's what this channel is all about. I'm Brett, subscribe to Money in Motion, and I'll see you in the next one.